The key event for markets this week has been the Federal Reserve interest rate decision, where they've raised rates by 25 basis points as expected, and the path for interest rates has slightly steepened. So we're expecting 3 rate rises in 2017 and 3 the following year. That's meant that yields have gone up in America. Also, the dollar has strengthened, and that's had a negative impact on the price of oil and on metals. This is the last market update for the year, and ahead of a video that we're going to produce next week on the predictions for 2017, we're just starting to address a few questions from clients with respect to portfolios going into next year. We're addressing 4 today. The 4 are we buying the Brexit discount? Will bund yields stay low enough to allow that structural residential property story in Germany to play out? Are banks now growth stocks? And finally, is 2017 the year for AI and machine learning? That's it from me. Thanks very much.
The European Central Bank announced last week that it will extend the length of its asset purchase program, albeit at a slower pace, and that it will expand the universe of eligible bonds by adding shorter dated and lower yielding securities. The market reaction was for the German government bond yield curve to steepen, with the 2-year bond yield falling to the lowest on record earlier this week, but the yields on the longer dated German bonds rising. Nevertheless, yields remained some way below the starting levels of the year, and we could see a further increase in yields during 2017, with an improvement in growth in the Eurozone and a modest pickup in inflation metrics. Despite this, however, inflation remains subdued, and with elevated political risks in the region in 2017, we expect ECB policy to remain very accommodative, particularly relative to the US, which we believe will restrict any large movement upwards in bond yields.
Certainly since the presidential elections in November, which Donald Trump won, the outlook for US banks has changed to become more of a growth stock. There's 4 reasons driving this. Number 1 is the increased inflationary expectations has resulted in steepening of the yield curve, which benefits banks that have a large amount of excess deposits, that it increases their interest earnings. Secondly, Donald Trump has been quite vocal in the past about the need to relax some of the more onerous banking regulation, and this could be beneficial to banks in terms of allowing them to release more excess capital. Thirdly, he's spoken about boosting infrastructure spending, and this could be beneficial to banks in terms of a boost to the amount of commercial lending that happens in the market. And the final potential benefit for banks is his proposals around the lowering of the corporate tax rate. US banks tend to make most of the money in the US and pay a fairly high tax rate, well over 30%, and so proposals to lower the tax rate to sort of 15 to 20% would be very beneficial for banking earnings. So overall, US banks do look quite attractive following the presidential elections.
So in some of these sectors I have exposure to, the Brexit discount looks a bit overdone. One company that's been quite negatively impacted is Marstons, the pub and brewing company. So if you look at this chart here, a lot of the divergence you're seeing between Marstons' share price and the FTSE 250 index is investors discounting rising cost inflation. This is fair enough to a degree, but it's worth noting that the company has fixed the majority of food and brewing costs for next year, and also has lower exposure to business rates than the wider industry. Even before the Brexit vote, I don't think Marstons have been given sufficient credit for the massive improvement they've made to their pub estate. Profits per pub are up around 50% since 2012, and the group just continues to outperform the wider pub sector. I really like the brewing business as well. It's only about 12% of profits currently, but it's growing nicely. And the group has some great brands. Hobgoblin is number 2 in the premium bottled ale market, and Shipyard is number 2 in the craft segment to the on-trade. I think putting all these factors together, the shares trading on less than 10 times earnings and yielding 5.5%, nearly 2 times covered, the shares look good value, and the Brexit discount looks a bit overdone.
We recently attended a tech conference here in London, and it seemed that everyone was talking about artificial intelligence. On the hardware side, there was lots of talk about how AI was going to drive increased demand for faster and more powerful chips that can be used in data centres, as well as things such as next generation cars. On the software side, there was lots of talk of companies of how they can improve their own products internally, but also how they can offer stronger returns on investment for their customers. And on the networking side, there was lots of talk about how the massive amounts of data that will be generated and analysed, and what this means for driving demand for fast networks and larger data centres. We cover a number of stocks that play to this theme, including Amazon, Alphabet and Microsoft, all of whom are expected to be large players in the AI space in the next few years.